here we are. How was it, your lunch? Was it okay?
Yes. Yes.
So, as I told you, what we have to do now is to continue with the presentation of a set of slides of convertible bonds and so on. Moving forward, we will prepare the prominence case. I hope you remember that we interrupted for the lunch break while discussing the conversion premium. Okay? And I told you that the conversion premium is the percentage difference between the conversion price and the market price of the shares of the issuing company at issue. Okay? In this case, 20/15. Okay? Generally speaking, when a company issues a convertible bond, the features of the convertible bond are exactly those that are described on this piece of paper. What I mean is that there's always or almost always an embedded conversion premium in the convertible bond contract. Why do we have this conversion premium? What is its financial meaning? Oh, by the way, do we have newcomers in the afternoon? Yes, as usual. We have the slides printed here for those who have joined us after the lunch break. In case you want them, they are here, okay? You can take them also after, later, but let's avoid interrupting in the presentation. What is the financial meaning? Why do we have this conversion premium? The idea is the following. Just think for a second. What may happen if suppose that this price, rather than being 15, is 22 for 1 second. And suppose also that you could subscribe the convertible bonds today, okay, and potentially convert them into shares tomorrow morning, suppose. If this price here is 22, would you convert or not tomorrow morning your bonds into shares?
Yes.
Yeah, exactly. Why?
The market price is higher than the one that I
Exactly, brava. Exactly. If this one is 22 and this one is 20, and you have the possibility of converting the bonds into shares, you would convert. Why? Because you would be paying 20 what is traded on the market at 22. So you may make a good deal. Okay? And that's the opposite example. Let's take a look now at the real numbers which are written on the piece of paper. In this case, we have that the market price is lower than the conversion price. The question I'm asking you is purely rhetorical, having already answered correctly to the previous example. But would you, if you had the opportunity of converting into shares, would you convert or not, given the numbers that you see on this piece of paper? No. Why? Because you would be paying 20, what you could find directly on the market at 15. It's not convenient for you. You would pay a higher price than the market price. Why should you go for that, right? And what would you do in this case? In that case, you would ask for the money back. Okay? So, the story, let me change the piece of paper. If you have understood this important concept, we can now try and translate it into a graph. And the idea is the following. Suppose that we put on a graph time, and here the prices. Okay, and we have the conversion price, say time 0 means today issue date, and T here maturity. And in our example, the maturity was 5 years, right? 5 years. So we have 0, 1, 2, 3, 4, 5 years. 1, 2, 3, 4, 5 years. Okay. We know that the conversion price which in our case was 20 euros, conversion price. 20 euros. It remains unchanged, fixed over the life of the bond. So, if you agree with me, I would describe this conversion price as a flat line. Okay? This is the maturity. This is the conversion price. The market price is 15 euros, right? Market price. So the market price at issue is lower than the conversion price. Now, pay attention to this important element. I would say crucial element for understanding the financial rationale of a convertible bond. Why do companies deliberately set the conversion price at a higher level than the current market price? In our example, 33% higher than the current stock market price. Because the idea is that you, as a bondholder, you will subscribe those convertible bonds only if you believe that the share price will increase over the life of the bond and breaches this level of the conversion price, goes even beyond, because that beyond, the difference between the actual market price and the conversion price is going to be your capital gain. So the idea is that, let me describe it. The share price could go this way, then you are betting on the fact that it goes beyond this level and it goes up. Okay? Because in this area here, it is convenient for you as a bondholder to convert your bonds into shares, since you will be paying this price while the actual price on the market of the shares is higher. And theoretically, you could sell the shares and get the capital gain. You understand what I mean? Now, if it is in our example, is a 33% conversion premium, your expectation is that over the life of the bond, which in our example is 5 years, the share price increases by at least 33%, which over a time span of 5 years means 6% per year, 5% per year. So we can draw a conclusion. If you are a convertible bondholder, a potential convertible bondholder, you would be tempted to subscribe those bonds if and only if you believe that the share price of the underlying asset is expected to increase. More specifically, it is expected to increase by at minimum the percentage of the conversion premium, because that's the minimum increase of price that would make you happy. Below that percentage, you wouldn't convert into shares. You will keep the bonds. If above that percentage, and needless to say, the higher the better, okay, above that percentage, you're gonna get a potential capital gain. So presumably you will convert the bonds into shares. Okay? Is that clear? Can you follow me? Because there is an important corollary of what I just said. The corollary is the following. Mr. Salvi, which is me. What you just said it implies that the convertible bondholder will have a return, overall return from his investment, his or her investment, given by the sum of the coupons that he or she receives over the life of the bond, plus the capital gain that we have just commented. So I have a question for you, Professor. Wait, isn't it too much? At the end of the day, your return as a bondholder is a cost for me as the company, right? There's no free lunch. What you earn is what I lose. How does it work in practice? It works exactly the way I'm telling you now. Comma. When a company issues a convertible bond, it puts on a balance. There's a trade-off. If you go back to the trade-off, there's a trade-off between a higher coupon and a lower number of shares, or a lower coupon and a higher number of shares. You cannot kill the cow and get the milk. You like this? It's nice, isn't it? So in other words, what I'm telling you is that you cannot expect too much, because nobody's giving you too much. It's giving you the fair intermediate remuneration that you would expect as a hybrid security holder. So the deal, it's a bargain. The deal between the company and the subscriber is, do you want more interest expenses and a lower capital gain, or the other way around? You cannot get both. Okay? And the story goes as follows. The higher the higher this difference, the higher the conversion premium, it means that the more difficult for you is going to be to become a shareholder. The higher this difference, in exchange for that, you would expect a higher coupon. Let's put it this way. It's a rhetorical question. Suppose that in our example, rather than being 20, the conversion price is, we set the threshold at a higher level. Say, I don't know, 27 euros. It means, and the share price is 15, it means that it's going to be harder for you to become a shareholder, because the price should increase at least at 27 euros. So it's going to be more difficult. It's easier to overcome this threshold than this one. Okay? So since the probability in this alternative scenario, scenario B is a real scenario, since the probability in the scenario B of converting into shares is lower than the probability in scenario A, right? In this scenario, in the scenario B, you would ask for a higher coupon. Right? You're making my life harder. In exchange for that, you should give me a higher interest rate. It's a deal, like in a flea market. Huh? Coupon in B is higher. Okay? You understand the deal? This is the heart of the convertible bond. The essence of the convertible bond. Understanding the trade-off between the coupon and the expected capital gain. It's an expected capital gain. You may never get it, because the price, rather than going this way, like I've described on the graph, it could go this way. If it goes this way, you never convert. Okay? But at least, even if it goes this way, it means that you, at maturity, you don't convert. You convert only if it is above this level. You don't convert, you ask 1,000 euros back. Right? So it means with the benefit of hindsight, ex post, your investment as a convertible bond at the beginning turned out, unfortunately, that you have remained a bondholder. You have never become a shareholder. Okay? But there is an important caveat that you must consider, is that you have lost your bet on the capital gain, let's put it this way, in this situation, but you still have a bond and you still have a mattress on which you are landing. The fact that you are bringing back the money home. The beauty, if I may use this word, which is probably excessive, the beauty of the convertible bond. Why are convertible bonds in some circumstances, in some specific periods, for example, this period, for example, after a crisis or immediately before a crisis, very popular in practice? Because those who are in love with investing in shares, by investing in convertible bonds, they're investing in shares implicitly, indirectly, later on, with a safety net. And the safety net is represented by the fact that even if you don't convert into shares, shit happens, at least you have a bond. And the bond will protect you from losing all your money. The alternative for you would be to invest directly in shares. But in that case, if you invest in shares, you may have a higher capital gain because you're not paying this difference, a higher capital gain, but the probability that you may lose all your money if the share price goes to zero is credible. It may happen. It's a beauty. I mean, I'm in love with these things. I'm sorry if I use these emphasis, but the convertible bond is the poetry of finance. Why? Eccessivo. It's the point. Why? Because you can fine-tune the features of the instrument according to the specific needs of the company. And that's very important. And in fact, convertible bonds are particularly interesting, and they are more specifically used for companies which are in their startup phase or rapid development phase. You rarely will see a company, or rarely, no, that's wrong. It is more likely that you observe a company in its early stage of development issuing a convertible bond rather than a mature firm. Why? Because as I told you, well, let me show you the San Antonio chain of the things. You are a startup firm, okay? You have a very credible business idea, you want to develop it, you want to focus your attention on developing the business idea, right? You as an entrepreneur, I mean. But you need money to finance the growth of the firm. Alternative number one, I knock on the door of banks. You knock, nobody's going to answer. Why? Because you're a newcomer, you don't have guarantees, you are un spiantato. They close the door. Trust me. Alternative number two, I could raise the capital. Equity capital. Oh, that's a good deal, but there are two alternatives in this case. Either increasing capital means either you invest your own money, and in a lot of cases you may not have an adequate amount of money to finance the equity of your firm, or you could ask to external new shareholders. But if you want, first of all, if you let other people enter into your house, you don't know who's coming in. It may be the best person, investor on the planet, or the other way around. And secondly, you get diluted in your percentage of shares. You used to have 100% of shares, you increase the capital and the others subscribe the new shares, by definition, you will have a lower percentage of your firm. And this is something that normally entrepreneurs, they don't like it that much, as you may easily understand. But so even if you go for equity capital, it's okay, it's definitely more popular than bank debt, but it's not exactly at the center of the heart of entrepreneur to increase the capital to finance the growth. While venture capitalists and companies frequently use convertible bonds for financing the growth of the firm. Why? Because Antonio, you said before that one of the interesting features of a convertible bond is that normally they bring a lower coupon than traditional plain vanilla debt. Why? Because in exchange for the lower coupon, we're giving a capital gain. Okay? Thus, if I may bring your logic to the extreme, if I write the contract in such a way that the capital gain component is very attractive, the coupon could be even close to zero. Yes, exactly. That's exactly the way it works. Actually, there are even zero coupon convertible bonds. And zero coupon convertible bond is a bond where, in exchange for the zero that you are not giving to your subscriber, this difference should be very negligible or even non-existent, so that you are betting on the capital gain, you don't care about the interest rate. And if the company is a highly promising firm, like the good startup firms, who cares about getting a 1% interest rate more or 1% less? That's not what you're betting on. You're betting on 100% capital gain. You understand what I mean? So in some cases, the convertible bond could be absolutely favorable. Other circumstances in which the convertible bonds are strongly appreciated by investors is when there is uncertainty on the market. When there is a stock market. When there is the uncertainty on the stock market and you want to subscribe, you as an investor, you are willing to invest in shares, you get your cagotto. You get scared, right? You say, wow, we are on a roller coaster. Who knows what's going to happen, right? I could go up even further, or it could be a dramatic fall, right? If only I could have a safety net. The convertible bond is a safety net. Finally, if there is this delta between the share price and the conversion price, which is a sort of an increase of the price in order for you, a delta price that you need to pay for getting the shares, this delta reduces the dilution of shares for shareholders. In other words, suppose that today I have to raise 1 million euros. 1, 2, 3, 1, 2, 3, 4, 5, 6. Okay? 1 million euros. And suppose that the conversion premium, conversion price is 20 euros. How many shares do you need to issue? 1 million diviso 20 is 50,000 shares, right? 50,000 shares. Okay, new shares. Giusto? This if you go with a convertible bond, because you set the price at 20 euros. Suppose that you want to increase the capital. Alternatively, you have alternative one. I could consider the issue of a convertible bond in order to raise this 1 million euros. What is the price that I'm paying in terms of dilution? 50,000 new shares subscribed by Boo. We'll see who's going to be this guy or lady. Let's cross the fingers. Alternatively, you could say, you know what? I convert. Let me increase the size because otherwise you don't see that much. Castorama issued a convertible bond in 1996, which had an expiration date in 2002. Okay, so it's a rather long duration. Normally it's slightly lower, it could be between 5 to 7 to 10 years. Sorry, forget it. It's after this is not a long one because 96 to 2026, 7 years. So it's perfectly, but it makes sense with what I was saying. Normally it's around 7 years, 5 years, 10 years. What were the features of, why did I choose this example? Antonio, why Castorama, right? Because this example, this picture here is like, I don't know, a Caravaggio painting for me. It's an evergreen. What do you mean, Antonio, with evergreen? It's one of the few circumstances, the other one was, for example, Air France, the one that I'll show you later, where on the stock market were traded both the shares of Castorama and the convertible bond. So I had the possibility of downloading the time series of prices of both instruments. Normally, the convertible bond is not traded. Okay, so you don't have one of the two lines here would be missing. Okay, and secondly, because this is really a textbook exam, it's amazing. It seems to be done deliberately. Okay, what do we have on this graph? We have the maturity of the bond. Okay, we know that. The bold horizontal black line is the conversion, the conversion price, which in this case was perfectly equivalent to the face value of the bond, since the conversion ratio was one bond for one share. You give me one bond, I give you one share. In the example I showed you before, the ratio was, how much it was? 50, right? Conversion ratio, 50 shares. In that case, 50 shares. Here is very simple, one bond, one share. Okay, and the conversion price was more or less around 47 euros. This line here is around 47 euros, okay? What else do we have here? We have the black line, black curve here, which is the share price of Castorama. The red line here is the convertible bond price of Castorama. Okay? And I have ideally divided the life of this bond into three sub-periods that I have named bond, hybrid, and why? Take a look at what happened, because this has expired, so this is with the benefit of hindsight. What happened in this example? For the first 6-7 months, no, sorry, devo cambiare le occhiali. 1.5 year, what happened was that, let me oversimplify, the share price of Castorama went down from 40 euros to 20 euros, more or less. Going down in 1 year or whatever it is, from 40 to 20 euros means 50% less. What happens if you are a shareholder? Cagotto. It's an English expression. You get scared, right? On the other side, take a look at what happened to the convertible bond price and thus the convertible bond holders. They were at the Maldives. They were sitting back relaxing. Che bella panza. Take a look at the shareholders, they're scared. We, the share price, with the pinch of salt, flat line around the redemption price. Why? Because that is the floor below which you don't expect to go as a convertible bond holder. You know that if the price, forget the second and third part of this graph, so suppose that the dynamics remains the one of the first graph, you know that you will not convert into shares. That's it. But at least you will bring back your money, which is 47 euros. On the other side, the shareholders will lose everything. Okay? So for the first period, actually, you feel, if you are a bondholder, a convertible, how do you feel? You feel like a bondholder. You know, okay. The capital gain is very far. The probability will convert is close to zero, right? In this period. We are de facto bondholders. The word convertible, forget it. It's a bond. Conversion is all. Then, suddenly, let's say from this period on, the share price starts increasing again substantially. Okay? You see? And what happens to the convertible bond price? Si ringalluzzisce. Oh wow. Vuoi vedere che, do you want to see that? You never know that the share price is going up again. They start smiling, say, oh my God, that's really an interesting period because we know that we cannot go below 47 or whatever it is. But if the share price increases and increases substantially and permanently, there could be the possibility, the probability that we may sooner or later convert into shares. The convertible bond price starts increasing following the increase of the share price. In this period, you know that there is some probability, at least vis-a-vis the previous period. In the intermediate period, there is some probability that you will convert into shares, okay? Because the share price is approaching and even breaking the threshold of 47. So you believe that the probability of converting into share that used to be close to zero in the previous period now is increasing. You still feel somewhere in the middle. You're not certain that you're going to convert, but you're no longer certain of dying as a bondholder. And then finally, the third period arrives, when the stock price of Castorama increases, breaches the level of 47, and it remains substantially and permanently above that level. What happens to the bond price? It behaves exactly as the share. It's amazing. Why? Suppose that this is a convertible bond of Castorama, and you are in December 2000. I have this convertible bond that says you can convert one bond into one share. Actually, you also have some coupon, okay, which from my mother. Tan wants to buy the bond from me. Antonio, can you sell this? Yeah, sure. What is the price at which you want to sell it? Tan, it's like a share. I'm selling you something that virtually is like a share, because as soon as you can convert, you will. Give me the price of one share. And that's exactly what the market is doing. It's treating the convertible bond de facto as one share. If you show this graph to a lawyer, he gets crazy. Or she gets crazy. Oh, non è possibile. No, come on. Because for a lawyer, and I love lawyers, I'm graduated as a lawyer as well. A lawyer with a convertible bond loses, si incasina, no? She or he, oh, where am I? A bond, what is this formally? According to the civil code, the convertible bond, according to the civil code, is a bond. Un debito. Can you really say that in this period you have in your hands a piece of paper that can be treated as a bond? That's the beauty of finance. Finance looks at the substance, at the real substance of things rather than the formal ones. And what the market is telling us is that that piece of paper on which apparently you see convertible bond, actually, if you read the inchiostro simpatico, you know, that transparent ink, it's written one share. But the lawyer doesn't see one share. He or she sees one convertible bond. He gets crazy. He gets crazy. And the worst thing is that not only the lawyers, even the auditors, they get crazy. And the financial analysts, they get crazy. And so they don't know how to treat them. Antonio. Yes? E quindi? So what would you suggest? I don't suggest. What I'm telling you is that if you look at this graph, you should behave your attitude depending on where you are on this graph. So if you want to, and which I show you an example, if you want to compute the weighted average cost of capital of Castorama, and you are in the first period, tutto a posto? Cinghialino, tutto bene? When you are in the first period, how would you treat the convertible bond? I would treat it as part of debt. The D of the weighted average cost of capital formula, the D would include also the bond. But what happens in the third period? I would no longer treat it, I would no longer include it into the bucket of debt. I would include it, the convertible bond, into the bucket of equity. Because I don't care what the civil code says. I don't. I care what the real substance of things is. And this convertible bond changes its physiognomy over the years. This is a successful case. Why successful? Because the bond was converted into shares. Let's take a look at an alternative. Right? Air France. It's written in Italian because this is taken from the Italian textbook, not the English one that you have. And you see, but most of you are Italians, most of you know what we're talking about. Ibrida means hybrid, azione means shares. Hybrid again, ibrida, obbligazione, bond. And what we have here is exactly what we used to have in the previous graph. We have the horizontal dotted line, which is the price of the convertible bond. Redemption price of the convertible bond. The black bold line is the real price, the market price of the convertible bond. And the bold gray line is the price of the share of Air France. Take a look at this. This is exactly the opposite, right, of the previous graph. It tells you that, unfortunately, over the years, in this case it's a 10 years bond, over the years the share price of Air France has decreased substantially, okay, and the convertible bond price has progressively rested on the redemption price. So it means that the probability of conversion in this case was close to zero, and in fact the bond was not converted. And if not converted, what do you get back? 20 euros per bond. 20 euros per bond. But at least you get the 20 euros. These guys, they have lost everything, almost everything. Okay, this is an example, the opposite example vis-a-vis Castorama, because in this case the convertible bond didn't work. Okay, don't forget an important point that I didn't mention, but it was de facto implicitly behind the lines. If you're considering of subscribing a convertible bond, you do it only if you are optimistic about the future of the firm. Alternatively, why should you go for that? If you are here, okay, at the issuance of the bond, and you know or you expect that the price of Air France will decrease to this level, you shouldn't subscribe to convertible bonds. You should stay away from the company, actually. What probably your expectations were this dynamics of the share price. And unfortunately, I don't know what happened. Actually, I know what happened. It was the crisis of 2008 that pulled down the price of Air France. It's a bet that you're making at the end of the day. But it's a protected bet, because you know that the worst that can happen to you is to lose the capital gain component of your remuneration. But at least you will bring back the money, unless the company goes bankrupt, that's obvious. You bring back the money plus the interest rate that you get over the life of the bond, which is something that in some cases you should not forget. Okay? Can you follow me? An additional thing I wanted to tell you, where is it? If we go back, you remember this list here. Because I want to convince you, I want to say something that hopefully will convince you about the high flexibility of convertible bonds and the fact that these convertible bonds are frequently used for financing the growth of promising firms with an appropriate design of their characteristics. In this slide here, you probably see somewhere here in the middle that there is an acronym that says LYON, Lion. This is the LYON. You see? LYON stands for liquid, yield option note. Okay? And it's a convertible bond, like all the others. Okay? But probably, according to my humble opinion, is the most, how can I say, poetic convertible bond that it has been experienced so far. Just to give you an idea of the companies that have used in the past these Lion, Lion, L-Y-O-N, I don't know how to say it, but you understand what I mean? Okay? Companies that have used this are Amazon, Google, Disney, Yahoo some years ago. And the first company that issued this, for which Salomon Brothers, which was an investment bank, no longer existing, in 1987 issued this Lion. It was the first time they were issued. Well, the first company for which these bonds were issued was a company that I still think it does exist, but it has lost momentum over the years. The company is Motorola. You are very young, and that's good for you, but I'm a little bit substantially less younger than you. And I remember perfectly that during the 80s, beginning of the 90s, just to go straight to Motorola was what the iPhone is today. There was a startup. Have you ever seen the mobile that opens? Right. That was an invention of Motorola. And it was the mobile phone during that period. And the company was. Then iPhone arrived, and other competitors arrived, and they have lost momentum. But it was really terrific success. And that was the first time for which the Lions were used, for financing the growth of Motorola. What are the characteristics of these Lions, and why am I so in love with this incredibly powerful instrument? A Lion is a zero coupon bond, zero coupon, subordinated, convertible, callable, putable bond. And probably I've missed also something. Zero coupon. It's a bond, zero coupon. Convertible, subordinated, callable, putable. Yes, these are the 5 features that it's a nightmare. What the hell are you talking about, Antonio? What is this? No, it's not written there. Don't look at that. No, it's not written. You're wasting your time. And it was 1985, Merrill Lynch. But the most important one was Motorola, yeah. By the way, lo ripeto. Zero coupon, subordinated, convertible, callable, putable bond. The problem is, what the hell does it mean? And why are you so in love with this instrument? And what kind of really deep perversion you have? Let me explain. Let's suppose that, well, actually, it's not an assumption. There are 2 counterparties, right? There is the company and the subscriber. Suppose Motorola and potential subscribers, okay? You are Motorola, you're issuing the Lion. The first characteristic of the Lion is that, the first one that I've mentioned, is that it's a zero coupon. A zero coupon feature, do you think it's a bullet in favor of the subscriber or the company? The company. It's a bonanza. You subscribe a bond, I don't give you an interest rate. Bravo. Pat. That's a very good idea. Bravo, subscriber. Zero coupon, which means that I don't have to pay on a regular basis an interest rate. I can use all the profits generated internally to self-finance the growth. Very good. 1-0. for the company. Okay? It is subordinated. Is it in favor of the company or in favor of the subscriber? It's a rhetorical question, I know, but please answer. Subordinated means that you have found a stupid guy in the street that is accepted to be the last in the row. In case the company goes bankrupt, he sits at the table when there's nothing left on the table. 2-0. 10 minutes, 2-0. Convertible bond. Convertible bond is debatable, right? The conversion option is debatable because on one side, the company could say, haha, that's good for me. Why? Because I get less diluted. Ah, bravo. Ma fa che ce neanche a me tesoro, eh? Why? Because I can get a capital gain. And then there is the umbrella. No? You know what the umbrella is, right? Okay. The umbrella gesture. Chi è? Diciamo 2-1 o 3-0, depends on which side you are on. Callable. First of all, what does it mean, callable? Callable means that if the company gets bored, annoyed, fed up with that outstanding convertible bond, it can call it back. It can, we say rimborso anticipato, we can reimburse it before its maturity. Is it 3-0, 2-2, 3-1, 2-1? What is, according to you, this is something positive for the company or for the subscriber? I know you don't want to answer because it's too easy, right? But she answers. For the company, right? You know what? I don't want you to hold anymore this bond. Give it back to me. And you are forced, you're obliged to give it back to me. Clausola di rimborso anticipato, si chiama. And it's a weapon in the hands of the company. Corollary. Because you may be wondering what follows. It says, mumble, Antonio. Sta cosa mi puzzicchia. What do you mean? What the hell are you saying, Antonio? That I am the company, you are the subscriber. You have a convertible bond that can be converted. I am the company. I say, you know what? Give it back to me. And what happens to the conversion option? Che faccio? Vabbè. I lose on both sides, right? No. What happens is that if the company decides to call back the bond, you, at that time, you have the right to decide if you want to convert. By that, it's technically called I'm forcing you the conversion. I'm forcing you to decide. You're not waiting until the maturity. You're sitting back and relaxing at the Mauritius. I'm saying, hey guy, I want the bond back. What do you want to do? You want the money or you want the shares? I'm anticipating your decision. But this is a weapon in my hands, not in your hands. Because presumably what may happen, that I will call back the bonds as soon as the share price is going to go up. So that you get a capital gain, but not an extreme one. I want to give you a gift, but not a gift like it could be the beer king for ladies or whatever. It's una borsettina normale, sobria, okay? And I call back the bond. And you say, Anton, we have a question for you. Why the hell should we subscribe the bonds if it is 3-1 or even 4-0 for you? Right? And that's a very good question. What do we have you would say, what do we have in our hands? We are left at your decisions, we are unprotected, zero coupon. Why the hell should we subscribe this bond? This is clearly una truffa, a hoax. And actually, I hope you remember that I told you that there is a fifth feature, putable. This bond is putable. This is a weapon in your hands. It's not a weapon. It's a nuclear weapon. I'm fighting with a gun. You have a nuclear missile. What do you mean, Antonio? What is the putability option? The fact that if you are fed up of the bond, you can give it back to me and I'm obliged to buy it back from you. Wow! It's a nightmare for me. Because what could happen is, I call these bonds the Schettino bonds. Why? You know what, first of all, you know what Schettino is? Tan? You don't know what Schettino is? No. Schettino used to be, still alive, but used to be the captain of a very important Italian cruise ship, whose name was Costa Concordia. Quello là, quel tizio là, quel simpatico mattacchione, esatto. The Schettino bond, that, as we all know, the rules of the sea, they say that whenever the ship is sinking, the captain sinks with the ship, or is the last one to abandon the ship. In that case, he was the first one. No? Schettino bond. Why Schettino bond? It's not official, it's my definition. No? They're not called Schettino bonds. Because that was writing Schettino bonds. It's just an opinion, just to give you an idea. If you have the option to give it back to me, the bond, and I'm obliged to buy it from you, since you are unprotected, zero coupon, I have the call option, you don't have it, blah, 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 blah. You've seen, no? It's unfair. It's clearly asymmetrical. You want to have the right, as soon as you have the smell that something is going wrong with the company, you want to be the first one to leave. Because you're unprotected, you're subordinated, zero coupon, you don't even know where the company is. It's like it's on the verge of a hoax. What do we want to have in your hands? The right to exit, whenever you want. This is called putability option. And it's a nuclear weapon. Because imagine what happens if all the subscribers of the bonds, suddenly, as soon as they smell that there is some smoke in the air, they give back to the company and they want the money back. You were sinking, and actually, with the additional cash outflow that you need to use in order to service the repayment, the earlier repayment of the bonds, you're dead. You could have been in a coma, but actually you're dead. Okay? This bond this is really, I don't know which one you prefer. The Merchant of Venice of Shakespeare is a masterpiece because it is designed for financing the growth of the firm. Think about it. Now Tan could say, everybody with the benefit of hindsight is a great investor. So blah, blah, clap, clap, what you're saying is absolutely obvious. Okay, and I agree. Having said that, imagine those guys that have subscribed originally the Lions issued by Amazon, Google. Yahoo was not a terrific success, but some years ago, for example, Disney as well, before the development of parks. Were you betting on, as a subscriber, them having 1% interest rate, 2% interest rate? Who cares? Right? They don't care. Zero coupon. Zero coupon. Unprotected. Unprotected means subordinated. I forgot that actually there is a sixth feature there. There was some unsecured, subordinated, unsecured. Se proprio nella... Avete capito dove? Zero coupon, unsecured, subordinated, callable. Oh, madonna, ce l'hai proprio tutta, eh? Give me one nuclear weapon, the right to leave whenever I can. But this also means that the company is left alone. You raise the money and you do your business. Nobody's disturbing you, zero coupon. Nobody's asking you guarantees. You cannot provide guarantees because you're a startup, unsecured. You want to have the door, you want to keep the door open for potential additional bank debt or credit for running your daily operations. They are subordinated. What they're actually betting on is to convert those bonds as soon as possible into shares. As a subscriber of these lines, you don't want to remain a bondholder. You don't. You're betting on becoming the shareholder as soon as possible and getting a huge capital gain. That's exactly what happened with Motorola, Google. Actually, Google has issued repeatedly lines, different tranches of lines. So, that was the story of the line. I wanted to share it with you. The Schettino bonds done. Don't forget it. If you don't remember, somebody asks you during the interview, have you ever heard about the Lion bond convertible? Yeah, the Schettino bonds. Who told you that these are called Schettino bonds? Oh, crazy guy. Forget it. Okay? Problem. Antonio. Yeah, what time is it? Let's see this example. We're going to have a lunch. Ciao. The coffee break. And then we're going to work on the problem escape. Let me show you this example because it's rather interesting. Francesca could say, Antonio, yes, I have a question for you. Oh, finally, Francesca, today. Can I ask you a question? Oh, sure, absolutely, shoot. Suppose that I am estimating the value of a firm, okay? And I need to estimate the cost of capital of that firm because I use that as a discount rate, right? Exactly, yes. What happens if a company is financed also with hybrid securities? No, in other words, what I want to say is, we have always learned with Professor Miglietta, Baldi, who knows who you had in the classroom. We have learned from them that the weighted average cost of capital is a weighted average of KP or RD and KE or RE. Okay? Correct? Correct. But if we have the hybrid, a quale santo ci votiamo? Tram? Or which tram ci appendiamo? These are two technical expressions to mean what the hell do we do? Now, there are various alternatives in practice being followed by practitioners. Alternative number one, not in terms of importance, but in terms of what comes to my mind. That is mainly followed by French investment banks. The answer would be, Anthony, it depends where we are here, as we were mentioning before. If you're estimating the value of Castorama, in this case, and we need to compute the cost of capital of Castorama, if you are in the first period, we will put the value of the convertible bond in D, and still compute the weighted average cost of capital with two components. If we are in the third period, the opposite, we will go for equity. The only problem we would raise here in the intermediate period where we don't know where to put, in which bucket we could put the convertible bond, either in the first one or the second. Alternative number two, this is alternative number one. Alternative number two is to, let me say it, but then I don't know if you've seen it somewhere now, to split the value of the convertible bond, the overall value of the convertible bond, into two components. The value of the bond component goes into debt, the equity option, the call option, goes into equity. Think the convertible bond, if you want, can be considered as a package of two things. If you open the box, the Christmas gift, on which it is written convertible bond, right? Inside you will find two things: a bond, piece of paper, a bond, and ideally another piece of paper says this is a conversion option, a call option. Okay, if that's the case, and it is the case, you should be able, and you can do it, to decompose the overall value of the box into two components, the value of the bond and the value of the equity option. The value of the bond, you put it in D, in the weighted average cost of capital formula. The value of the conversion option, you put it in equity, in the weighted average cost of capital formula. Okay? Va bene? But there is a third approach. The third approach is the one that I'm going to show you now. Okay? If you want to compute the weighted average cost of capital using three components, not two components, but three components. Let me go back for 1 second to. Condividi cosa? Niente, already.
Videocamera.
It's already working at home.
Yes.
Okay, great. So, ma si non l'hai portato più. We are used to compute the weighted average cost of capital as follows: KD times 1 minus T times D over D plus E plus KE times E over E the D plus E, correct? Actually, in your slides, we have used RD here and RE here, but I told you it's only a matter of notation. Don't change, okay? What happens to this formula, what happens if we have, for example, a convertible bond? It happens that either you use one of the approaches that I told you before, or you could compute a weighted average cost of capital with three components. So KD times 1 minus T times, let's call convertible bond, the notation, let's use CB, okay? Convertible bond, times D over D plus convertible bond plus equity, plus the cost of the convertible bond, net of taxes, multiplied by the weight of the convertible bond divided by the overall capital structure of the firm, plus finally the equity component, the cost of equity, multiplied by, okay, E over D plus CB plus E. It means that we could add into our weighted average cost of capital a third component that in this example is represented by the convertible bond. It could be a preferred equity, it could be subordinated debt, it could be pay-in-kind debt, it could be mezzanine financing. These are all examples of hybrid securities. Okay? Okay, Antonio. Vabbè. It's a weighted average, no longer two things or three things. This is something that we still easily manage. In our notation, this could also be named R, say, C. Okay? Let's make an example using a weighted average cost of capital with three components. That's it. Can I go back to the slides? Okay. Let me follow the slides. We're going to share this example and then have a coffee break. Suppose that there is a bond with the following features, a convertible bond with the following features. It is a 10-year callable convertible bond. It means a convertible bond that can be repaid earlier than the contractual maturity at the discretion of the company. Obbligazione convertibile rimborsabile prima della scadenza. The coupon, il tasso di interesse, 3%. The par value, valore di rimborso, 1,000 euros. The straight debt issue would require 5% coupon. It means that the company pays on its outstanding normal debt 5%. RD, you don't see it anymore. RD or KD is 5% for the firm, in other words. The bond has a call protection. Call protection is called hard call for 5 years. It means that for 5 years, the company cannot repay the bond at its discretion. So there is the clausola di rimborso anticipato, but you cannot exercise it for the first 5 years. It's called, technically called the jargon, actually. It's called hard call. Then there is also a soft call price, 1,100 euros. What does it mean, this one? It means that the company is entitled to call back the bonds after 5 years. First, it must wait 5 years. And the second important condition is that if the company decides to call the bonds back earlier than expected, they must pay an indemnity to the subscribers. They are not going to repay 1,000, they're going to repay 1,100. So you need to offer something more as a partial indemnification for the fact that I'm extinguishing the bond earlier than expected. Okay? Capito? I'm creating you a damage because I'm retiring the bond from the market earlier than expected. In exchange for that, you say, you know what? I don't want to have 1,000 euros, the price that you would pay if you would get patient and you repay the bond at maturity. If you want to repay the bond before maturity, you need to give me an incentive. I don't know how to call it. It's an indemnity, actually. An indemnity is set 1,100. 10% more. Okay, is that okay for you? Okay, yeah, it's okay. It's a soft call. Let's also assume that the price of the shares of the company issuing the bond at time zero, means the issuance date, is 20 euros. The dividends distributed this year is 1 euro per share, 5% yield. The growth rate of the dividends is expected to be 6%. The conversion ratio of this bond is 40 shares, and the tax rate is 24%. Conversion ratio to 40 shares, it means that the conversion price is 1,000 divided by 40. The calculation we have made before the lunch break. 1,000 divided by 40, which is 25 euros. That's the conversion price. Anton, see? Are we exactly in the same situation we were observing before of a conversion price which is higher than the actual current stock market price? Let's check. The share price, according to the slide, said it's 20 euros, you see? The conversion price is 25 euros. It means that there is a conversion premium. In this case is 20%. The difference between 20 and 25% is more than 20%, but around 20%. Okay? Quanto è precisamente? Sapete di calcolo? 25 divided by 20 minus 1. 25%. Esatto. 25% conversion premium. Okay? Do you understand now? That's the starting point, but our goal is to compute the weighted average cost of capital. Okay? What happened? Think about it. What could happen with this bond? You want to have rest now, or and and we're gonna comment this after the break. What would you prefer doing? Va bene, andiamo avanti. What could happen is what follows. A scenario, the actual scenario that could presumably occur. We are dealing with the future, so these are estimates. But these are the best estimates that we are able to do now, given the assumptions we have made in the exercise. What happens for the company? The company issues the convertible bonds and it gets 1,000 euros per bond. You see, it's a plus 1,000. Then there are 5 years in which nothing can happen because there is a call protection period. What happens is that our bondholder gets a 3% coupon per year, okay, which is equivalent to 30 euros per bond per year. Okay. Then year 6 arrives. Are you sure that we are sharing these slides with your colleagues at home? Okay. Then the 6th year arrives. Ta-da! That's the first year in which the company can do something alla Schettino. Say, 5 years, siamo stati buoni. 6 years, What happens What happens in year 6? It happens that if our assumptions hold, I have a stock price, okay, 20 euros, the assumption, that will have grown for 6 years at 6% per year, according to our example. Okay, where is it? And in fact, you see it here. That grows at 6% for 6 years. That grows at 6% for 6 years. Okay. And this is the value of a single share. But if year 6 the bondholders convert, they have the right to get for each bond 40 shares. So you have to multiply this single increased at 6% for 6 years, single share price, you have to multiply it by 40. And what the shareholder would get, in case the assumptions hold, is 1,000, a package. The box, the value of the Christmas box would be 1,135. What do you think the company would do in year 6 if these assumptions actually occur? Bravo, Tom. Say it again. Call back the bond, subito. You have waited. Have you respected the conditions? Yes. I've waited 5 years. It's the 6th year. Okay. Am I respecting the soft call provisions of 1,100? Yes, I'm going to give 1,100. Okay. Sorry, I'm not giving 1,100. I'm allowed to call back the bonds if the value of this package is higher than 1,100. Is it higher? Yes, 1,135 is higher than 1,100. I can call back the bonds. Will I call back the bonds? Presumably yes. Why should I keep these bonds staying around? If that's the case, the bondholder will receive a package whose value is 1,135. But then the bond expires, it no longer exists. So now we are ready to compute the internal rate of return. You remember from Corporate Finance 101, tasso implicito, tasso interno di rendimento, or the internal rate of return? The nightmare is back. The internal rate of return is the way for computing what is the rate of return that I have provided, given this, me as a company, provided to you, if this is the stream of flows that is expected to occur. You compute the IRR of this stream of flows, plus 1,000, minus 30, minus 30, minus 30, minus 30, minus 30, plus minus 1,135. it's 5%. Okay? So this could be the cost of the convertible bond. Actually, we have lost something. We need to be more precise. The calculation is okay. The logic is perfect. There is only one thing that we're missing. What are we missing? The taxation. And it's reported here. The taxation, the fact that interest expenses are tax deductible. Okay, and we need to consider that cash outflow, periodical cash outflow, you remember, for 5 years, plus the sixth one, which used to be 30, but on that 30 we save taxes, 24% taxes, so our actual cash outflow for the first 6 years in terms of interest expenses is no longer 30, it's 23. We do it. We recompute the IRR and it's going to be 4.3%. This is our cost of the convertible bond, 4.3%. In our formula here, I'm going to write that, I'm going to show it to you. It's 4.3%. What about, what else do we need? KD or RD? Do we have RD? Yes, we do have it. It's 5%. How do I know it? It's written here. Straight debt issue would require 5% coupon. This means that this is the plain vanilla cost of debt for the firm. 5%. Okay, but 5% should be expressed net of taxes. Net of taxes, 3.8%. 3.8%. Why net of taxes? Because we have a tax shield on that. The only thing missing is KE. Do we have the data for computing KE? Yes, if we assume that we can compute the cost of equity by using the Gordon growth model. Okay. Gordon growth model says that the cost of equity can be measured as the dividend yield plus the growth rate of dividends. A dividend component plus a capital gain. A dividend component plus a capital gain. Do we have this information? Yes, we do have. It's provided in the exercise. The dividends next year will be the dividends of this year that are growing for 1 year at 6%. Okay, divided by the current stock market price, which is 20 euros, plus the expected growth rate of dividends that according to our exercise is 6%. So we apply this simple formula here. This is called Gordon growth formula. Okay, and what we get is 11.3%. Right? 11.3%. Okay. We are almost done. Okay. Shall I go back? Well, it's not necessary. We remember the numbers. So KD is 3.8, K convertible bond is 4.3, the cost of equity is 11.3, right? Okay. Now we're ready for making our calculation. Let's make two alternative scenarios. Okay? Let's assume that the company is currently financed with, it doesn't have any convertible bond. Suppose that the company doesn't have any convertible bond, it's considering of using or issuing convertible bonds. But now, the current state is that it doesn't have any convertible bond. That, for simplicity, let's suppose that it's capitalized 50% debt, 50% equity. Plain vanilla debt, plain vanilla equity. Okay, 50% debt. 50. Let's compute the weighted average cost of capital the good old way. If that's the case, we will get 50% of debt that costs 3.8% plus 50% of equity that costs 11.3%, right? What the weighted average cost of capital would be is 7.6%. Write it down. But now the company is saying, 50% debt, 50% equity. Why don't we go for some convertible bonds? Okay? And for example, replacing some of the existing debt with convertible debt. So we have, for example, 40%, you can go for 40% traditional debt, 40% equity, and 20% convertible bonds. If that's the case, we need to recompute the weighted average cost of capital with three things: 40% debt and the cost of debt, 40% equity and the cost of equity, 20% convertible bond and the cost of the convertible bond. And this is being done here in the second equation that you see over there. 40% debt that costs 3.8% plus 20% equity, 20% hybrids, correct? 20% hybrid that costs 4.3% from the IRR that we have computed, plus 40% equity that costs 11.3%. We compute it and we get a weighted average cost of capital 6.9%, which I hope you have noticed is lower than the original weighted average cost of capital, the actual weighted average cost of capital of the firm, which is 7.6%. If you were the entrepreneur, would you go for the convertible bond or not? I don't want to suggest you the answer. Yes. Why? Because by issuing convertible bonds, we are minimizing the cost of capital. We're getting a lower cost of capital. And all other things are equal, it means that the value of the firm will be higher. Right? Correct. Isn't it too good to be true? I mean, if that's the case, you would expect all the companies out there being financed with convertible bonds as well. This is not what you observe. How come? Why don't we experience all companies on this planet to have to exploit this opportunity of lowering the cost of capital by issuing convertible bonds? The answer will be provided after the coffee break. Enjoy your coffee break, my dear friends.
为什么不是所有公司都干这个？如果这么好的话，然后，
我是要讲 case 了吗？
我觉得应该讲了。
是那新的客户已经发的那个资
对
料，
，Oh my god，
还不少，哎发的，
剩下几天？3天？
就4周5跟周1 ，40 hours，
Oh my god，
还有 case，
Okay.
5个 lecture， 4个 mini case，
Oh my god，
A lot of people missing.
他也太多了吧！
If they're here or
刚松了口气又回来了，刚松了口气舒服。
By the way, I promised that I would have given you the answer to the question, why don't we observe, since there is a loading of the cost of capital, all companies are there to issue convertible bonds? The answer is the following. Well, let's put it this way. Suppose if you show these results, if you had the possibility of showing them because they passed away, but to Franco Modigliani and Berto Miller, the two good old guys, they would say there's a mistake in this calculation because it's too good to be true. And what is the mistake that they would argue it's behind the lines here? They would have said, I presume, Antonio.
audio，
There's no audio? Oh. Yes, they would have said, take a look and compare these two alternative capital structure. The first one is made up of 50% debt, 50% equity. Okay. The second one, and you get 7.6% weighted average cost of capital. The second capital structure has 40% debt, plain vanilla debt, 20% convertible debt, and 40% equity, which means that this alternative capital structure, the one that you are considering to move toward, is made up of 60% of debt and 40% of equity, vis-a-vis 50% and 50% in the previous circumstance. The second alternative is riskier for investors, because the second capital structure has a higher level of debt, which implies in turn, given all other things equal, that the company is riskier, okay? Becomes riskier, because it has more debt. But if that's the case, proposition number 2 of Modigliani Miller, you remember, would suggest that this cost of equity in a riskier situation, like the second one, should be higher to reflect the higher riskiness for equity holders of the alternative capital structure. And by increasing these 11.3% to a higher percentage, this difference between 7.6% and 7.9% would shrink, would narrow. And actually, Modigliani and Miller would say that the cost of equity would increase to such a level that would bring the difference between the first weighted average cost of capital with the second weighted average cost of capital equal to 0. So this number in the Modigliani-Miller world should increase, and thus this number should increase as well, to such a level, up to the point where it reaches 7.6%. Okay? Is it true? Is it false? That this is exactly what should happen in practice? We don't have conclusive evidence. What it is true, even intuitively, is that the two companies are not the same. Even if you look at it, they're not the same. The first one has only 50% debt, the second one has 60% debt. And thus, all other things are equal, is riskier. If it is riskier, the equity holder should expect a higher return, and thus the 11.3% should change. The second 11.3% should change to a higher level. How much higher? It's debatable. Okay? This example was provided to you in order to show you how to compute the cost of capital of a firm if convertible bonds do exist, and thus represent the third component of the capital structure of the firm. Okay? With this example, we also finished the set of slides on hybrid securities. What's left for today, actually 1 hour and 10 minutes, is to take a look and rapidly prepare the Promodesk case and sharing the solutions to the answers. Okay, so if you agree with that, I would interrupt the projection of these slides because they are no longer necessary, while I would open the case Promodesk. Okay, you have it on the platform, so actually you should also have read it, but I don't trust that much that you have read it. So not you, all of you. So let's take a look at it rapidly, since we don't have a lot of time to read, to prepare. Let's reduce time span needed for preparing. So let me present this relatively short case. Promodes case. Promodes, as I told you last week, I think, was a company that operated as a supermarket chain. Okay, this company, exactly as it happened with Castorama, no longer exists. Okay, it has changed the name after the takeover from Carrefour. So this company now still lives, but actually it's been merged into Carrefour. Okay, but it used to be called Promodes. At that time, in 1998, when the company decided to issue a convertible bond, it operated in 6 countries: France, Italy, Spain, Portugal, Greece, and Belgium. And 98%, so it means all the sales were obtained in these countries. They had a very broad spectrum of supermarkets, hypermarkets, supermarkets, hard discount stores, convenience stores, cash and carry. So they were rather complete in terms of the categories of supermarkets. The company had followed so far an aggressive growth strategy. Okay, either through the opening of new stores or with partnerships with independent chains. Blah 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 blah. Okay, it's written here, I don't remember. In 2000, Promodes merged with Carrefour. Okay, its stocks were no longer traded on the stock exchange. Now, the company was considering issuing convertible bond. Why? In order to finance an important expansion plan of the company. The manager decided to issue a convertible bond with the following features, and now we're going to explore. But what I want to highlight here is the rationale behind the issuance of the convertible bond that was explained with the need of financing the external growth, okay, the growth of the firm. So they wanted to raise money for opening new supermarkets or taking over an already existing competitor, okay, that operates in the same business. This is a classical reason for issuing a convertible bond, for justifying the issuance of a convertible bond, financing the growth. What were the major features of this convertible bond? It was a 5 years convertible bond, 1999-2004, 5 years. The coupon, 2.5%. The amount needed, around 600 million euros. Just for sake of clarity, 589 million euros. The number of bonds issued, 589,000 with a unit value of 1,000. Right? 2%. Well, 1,000 euros. So the face value is 1,000 euros. Okay. And since it is 1,000 euros, the amount of the number of bonds to be issued was 589,000. What else could be interesting here? Okay, the interest rate was 3.95%. The market interest rate was 3.95%. The spread for the company that the market applied was 0.5%. The conversion ratio, this is important. The conversion ratio is distributed as follows: 1 new share for 1 bond, exactly like Castorama, and completely different from our example where we put conversion ratio was 50 shares in our example. Here is 1 to 1. Okay, the bondholders have the right to convert into shares anytime they want, starting from the settlement date. So this is very aggressive. We issue the convertible bonds today 3 days later, settlement date, you see? 3 days later, you can convert if you want. This is rather rare. Normally, as we have seen with the example on the slides, there is a call protection period. That case was 5 years, could be in 1 year, could be in 2 years, could be 6 months. There is a call protection period. In this case, it does not exist. The stock price of Promodes at that time was 644, and thus the conversion premium is 55%. How do we get this 55%? 1,000 redemption value divided by 644 minus 1. That's a 55% conversion premium. These were senior unsecured bonds. The bond can be called back after 3 years if the stock price of Promodes is higher than 1,200. Soft call. Placing institutions, listing, blah, 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 blah. The questions are the following. Support a financial analyst understanding the rationale and the mechanics of the issue by articulating the analysis along the following points. Prepare a rapid analysis, financial analysis of the firm. This is something I can do for you. Second, prepare a rapid stock market analysis of the company. This is something I can do for you. 3, explain how convertible bonds can be evaluated. This is something we have already seen, but we will see it again and I can do it for you. 4, analyze the convertible bond of Promodes as a financial product for investing in terms of risk and return. This is something we have already done. I hope you remember it. It is the graph with the linear relation to risk and return, and I put the convertible bonds in the middle between bond and equity. That's the answer, so I can do it for you. Actually, we have already done it. Question number 5, you have to do it. Question number 5, because this is the question of the case. Compute the minimum growth rate of Promodes share price necessary for converting the bonds. Suppose the cost of equity is suppose it's an assumption. Cost of equity is 6.6% and dividend yield is 0.5%. Do you think that the probability of conversion is high or low? High means higher than 50%, low, lower than 50%. And then there is question 6, which is qualitative. What is the accounting cost of the convertible bond? Right, we see it together. What are the conditions that should be satisfied? Forget it, we can do it together. And even also the other questions, we can do them together. So what I'm asking you to do is only to answer to question number 5. The others will be examined together. Some of them have already been examined, but the others will be. In order to answer to this question, question number 5, you have the income statement of the firm over the last 10 years, the balance sheet, the cash flow statement, and composition, show the composition. This is less important for you. Stock market data is important for answering to question number 2, so don't care about it because I will do it for you. Stock market data again here is irrelevant for you. Interest rate on corporate bonds is irrelevant for question number 5. That's it. So what you need actually is nothing. It's information provided in question number 5 and information provided in the here. In the major feature of the convertible bond. The calculation could require from 2 minutes to a couple of days. So it's up to you. If you know what the question is actually asking you, it takes a couple of minutes. If you don't know what the question is asking you, you may die on that question. So I hope that in a couple of minutes we can gather again for the discussion of the 9 questions, including question number 5. But in any case, since we are good old friends and blah blah, we want to keep a good relationship, right? Now it's 4:16. we could probably, it's rhetoric, it's falsely democratic. We could probably gather again. You only have to answer to question number 5. At 4:30, 15 minutes. Is that okay for you?
So if you want to work in small groups here, you are warmly welcome. If you want to work individually, you can work individually at home. There are no alternatives. You work individually. So let's hope that you can solve question number 5. The others will be solved by myself. Okay?
Just to, since we don't have a lot of time, and it seems that you have not necessarily, either it was 1 minute or it was a couple of days. I suspect that it's not 1 minute. My dear beloved friends, first of all, I want to tell you something. Professor Almeida is just, oh, I don't have the microphone here. So, okay. I wanted to tell you something. Professor Almeida has just landed in Turin, and while bringing him to the hotel, he was asking if it is possible for you, only for tomorrow, to start 15 minutes earlier. 9:15. Is that okay for you? Okay, so we're gonna start tomorrow morning at 9:15 rather than 9:30. It's a minor change, and I wanted to tell you that, okay? And that's it. Now, shall we go through the single questions? Why not? Calculations. Question number 1, I'm going through the single questions, okay? Then we're going to reach the question, the unsolved question that you have tried to answer to. Question number 1 says, please prepare a quick, rapid financial analysis of the firm. What we can say is that the company, as like all supermarket chains, in terms of margin, well, actually, growth rate of the company is rather important. The CAGR over 5 years is rather important. You know what CAGR stands for? I don't know. Lo preguntavo, sul serio. CAGR stands for, ma scusa, ma Giorgino e company là che fanno? Niente. Giorgino, avete seguito il corso con Giorgino? Fa trading?
Financial markets.
Financial market, cavolo, CAGR, all financial analysts is a key metric that financial analysts use. By the way, stands for compounded annual growth rate. Compounded annual growth rate. It's il tasso di crescita annuo composto, and it's the key metric used by analysts when they want to compute the growth rate of something. Okay? In this case, the sales, it is applied to sales, and the annual growth rate is 6%, roughly 6%. How is it obtained? It is obtained, I should write, but takes too long. But it's, yeah, no, let me write, because otherwise you believe that I don't know the formula. This way. And this is something that you must know. So even if somebody else hasn't said that to you, you need to know because it's important. I mean, should be already, exactly, should be already working, right? Felice?
Sì,
Funziona?
sì.
Ok. CAGR stands for compounded annual growth rate. And it's the common metric used by financial analysts for estimating the growth rate of something. How is it computed? It's computed this way. It's the root of the ratio between the most recent level of the thing you want to compute the growth divided by the starting date of the time series minus 1 under the root where the root is given. Let me write. Suppose sales. Now we are considering sales. I want to compute the growth rate of sales from year year, I don't remember, where is it? 94 to 98. Okay, 94 to 98. Okay, 94 to 98 means how many years of growth? 94 to 95, 1 year. 96, 2 years. 97, 3 years. 94, 98, 4 years. So it's the fourth root of sales 98 divided by sales 94. The most recent level divided by the less recent level, and the root, where the degree of the root is given by the number of years between the first and the last day, minus 1 outside the root. And this is, in our example, 6%. Okay? This simple equation here could be computed, could be applied to sales, EBIT, assets, whether the recipe doesn't change. It's the inputs, the ingredients that may change. Okay? So let me go back to the need to integrate the camera. Share. Okay, so we are here. The growth rate is 6.05%, which is a remarkable annual growth. On an annual basis, if you grow at 6%, it's remarkable. Okay? The EBIT, which means the operating profit, has been relatively low because it's only on average 2.2%. But this is not a surprise because the company is a supermarket chain, and as you know, the supermarket chains, they have very low profit margins. But they play on the volume. They don't earn a lot on the milk and the bread that they sell you, but they sell a lot of milk and a lot of bread. Very simple business model, I don't have to. And that's it. In terms of the investments, balance sheet is here. You see that the tangible assets, that's the growth rate, that's the CAGR of assets. 24%. So the assets are growing even more rapidly than the sales. Even more rapidly than the sales. And this is not necessarily good news, because it's like saying that you're growing physically, you're becoming obese, but you're not running enough sales. You are eating more than needed. And in fact, the ROCE, you see that goes down progressively from 25 to 15%. It means that the company is sitting on their seat. Okay, let's go back to the balance sheet. In terms of financing, the company seems to be, let's see, it has, well, actually historically it has even a negative net financial debt for 2 years. It means that they used to have more cash than debt, so the company was virtually unlevered. And in 1998 they have 1 billion of debt, which presumably comes from the acquisition of another company, the payment for an acquisition of another firm. In any case, if you want to have a quick and dirty answer about is the company excessively leveraged or not, you could compare this 1,500, for example, with the EBITDA of the firm, which is not available here, but sorry, it's here. 166 plus 300. The EBITDA is 466 plus 300, right? 766. If you compare this number with this number, 1,015, which is 1 billion. 1 billion divided by 700 means a ratio of 1.2, 1.3, whatever it is, and it's very low. Just to give you an idea, your book is clearly stated that a ratio that goes beyond 3, 3.5, 4 starts being concerning for banks. This one is 1, 1.2. We still have residual borrowing capacity. Finally, in terms of profitability, the return on capital employed is decreasing, overall decreasing from 25 to 15%, and the return on equity is slightly increasing. You observe that the return on capital employed is always higher than the return on equity, and this is due to the negative leverage effect that the company experiences, since presumably the interest rate on debt that it pays is higher than the profit margin that they pay more to banks than what they are. In other words, so the more you leverage the company, the more you are in a worse position. If you don't earn enough for repaying your in the interest expense and you continue borrowing, you will be progressively worse. You don't need to be a wizard, it's one day in life. And that's it. So the company seems to be overall in a good position. Okay, overall, it's growing. It's investing, probably it's growing not efficiently because it's growing more the assets than the income. Okay, but overall we cannot say that the company that is on the verge of bankruptcy, it's completely the opposite. Question number 2, prepare a quick stock market analysis. For preparing the quick stock market analysis, we need to go to this table, this one, stock market data, and the graph. The graph reports Promodes from 94 to 99, blue line, and the French stock market index, pink line. You see that the company...
Così noi da casa non vediamo.
Vabbè, non vi perdete niente. In che senso non vedete niente?
Vede una schermata grigia.
Perché ha condiviso solo Excel, prof.
Ok. Porca miseria, ho capito, no, questo è un casino. Ogni volta devo fare di quelli.
Schermata 1, prof. No, prof, schermata 1.
Cos'è schermata? Questo?
No, a sinistra o a destra, quello. E condivide sempre quello che
è... lo schermo, sì, bravo.
Lo schermo in generale.
Bravo. Cosa sei? Quello che stavo facendo? No, proprio questo.
Sì, grazie.
Prego, you're welcome. Sempre benvenuto. Dan,
Yes.
the company is performing better than the market. That's
Yes.
good news, apparently. Even in terms of the multiples, where the P ratio, the company has a very high P ratio. So it means that the market has positive expectations about the firm in terms of growth, and that's probably also the reason for which the company has decided, is considering the idea of issuing convertible bonds of financing growth. Everything goes, you see. Even the ratio between the market value of equity and book value of equity, which is 5.2, is a very high level, because as they told you somewhere, I hope, this ratio, the higher the better, and it's a measure of the goodwill of the firm. If it is beyond 1, this is 5 times 1, which means that the company is definitely in a very good position. What else can we say? Not a lot, since we don't have a lot of time, but it is not necessary to elaborate excessively. Question number 3. No, question number 3 will not stay here. Question number 3, question number 3, question number 3. Explain how convertible bonds can be evaluated. Why can these estimates have a lower contractual rate than similar corporate bond with no conversion option? We have invested half an hour on this question before. Why do we observe that convertible bonds are frequently supported by a lower coupon rate than a straight or plain vanilla debt? Because the answer is because in exchange for a lower coupon, it's the other way around. In exchange for the possibility of getting a capital gain, bondholders could accept a lower coupon. That's the deal. Okay? Question number 4. Examine the convertible bond or promo-debt as a financial product for investors in terms of risk and return. This is the graph that I showed you. I'm referring to this graph. Remember? The answer is this graph. The answer is here. So, question number 5. And that's the question, right? On which you were lost. Calculate it, because this is very intriguing. It's an intriguing question. Compute the minimum growth rate of Promodeb's share price for converting the bonds. Suppose the cost of equity is, it's an assumption, is 6.6% and the dividend yield is 0.5%. Is the probability of conversion high or low? Okay? I need to go back to the boom, 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 boom. Okay. The idea is the following. What the exercise is saying is that let's assume that the cost of equity, for example, using the CAPM, we don't know, it's not written, but let's assume, is 6.6%. Okay? And let's also assume that the dividend yield is 0.5%. We know that the cost of equity can be computed with the CAPM, but also with, let's say, the Modigliani-Miller world. Okay? This is expressed in terms of risk. This is expressed in terms of return, which are two sides of the same coin. And according to the Modigliani-Miller world, the cost of equity can be computed. The remuneration of shareholder is made up of two things: a dividend yield plus a capital gain, right? Correct? In other words, you as a shareholder, you earn on your investment in the shares of the firm under two possible alternative or complementary forms. The first one is the dividend yield, dividends that you receive from the company. And second, a stock price appreciation, which means a stock price increase and a capital gain that you may get. Okay? The exercise also says, if markets work efficiently, if everything holds, the 6.6% CAPM cost of equity we have obtained should be the same that we would get by applying the Modigliani-Miller. No? It's not the way you compute the cost of capital. The cost of capital is the cost of capital is the cost of capital. It's not that by changing the way you compute it, you get a different result. No. If the cost of capital is computed appropriately, you should get 6.6%, no matter the methodology that you use. Okay? So let's assume that this 6.6%, which is provided by the exercise, is also the same percentage that we can apply to the Modigliani-Miller example. And the case says that the dividend yield of this company is 0.5%. It's written in the question. Now, I don't know what your opinion is, but this implicitly assumes that the capital gain should be 6.1%. Because 6.1% plus 0.5% gives you 6.6%. But this capital gain is equal to the growth rate. The growth rate of the stock price. Okay? Okay? Can you still say something? Okay. Now, this is a description of what we have in the exercise. Now we need to answer to question number 5 that says, what is the minimum growth rate of Promode's share price for converting the bonds, and thus, do you believe that the probability of conversion is remarkable or not? We have this expected, this is the expected growth rate by the market. Okay? What we have to do is to compare this expected growth rate with the contractual growth rate versus contractual embedded in the convertible bonds. Contractual growth rate. Okay? If we discover that this expected growth rate is higher than this, the probability of conversion is very high. If we observe the opposite, the probability of conversion is low. So we need to compute the contractual growth rate. How do we compute it? We use the CAGR. And that's why I mentioned it before, because it's always there, it's always useful. The CAGR of the share price. C of the share price. The CAGR is computed as follows. What is the current share price of Promodes? 644. It's written. It's written here. 644. Okay. What is the redemption value? In other words, what is the threshold that we must overcome in order for us to be convenient to convert into shares?
1,000.
1,000. Wow. How many years do I have of growth before this may happen? In other words, what is the maturity of the bond? 5 years. 5 years of growth, right? 5 years of growth. So do you allow me to write under the root, the fifth root, 5 years of growth? 1,000 is the final point. 644 is the starting point. Minus 1 outside the root. Okay? If you compute this thing here, and if your calculations are correct, what you get is 9.2%. So now we have the two percentages that can be compared. Pay attention to the interpretation of what I'm saying here now. According to the market, the stock price of Promodes is expected to increase at an annual growth rate of 6.1%. According to the bond contract, the convertible bond contract, in order to be converted into shares, the required growth of the share price on an annual basis should be 9.2%. That's what the market expects. That's what you require. What is the conclusion that you reach, that you draw? Right? Low probability of conversion. Why? Because you need 9.2 in order to be convenient, the bond, but the market only expects 6.1. You shouldn't subscribe these bonds. Or you can subscribe the bonds provided that the market is mistaken and this number actually will be higher. Your expectations could be different from the ones on the market, but it's a rather dangerous bet. Okay? It's dangerous. It's dangerous, okay? Because you are assuming that you are smarter than the market, which is a very strong assumption. Very strong. Almost impossible to beat the market. And it's also a very presumptuous assumption, because you are arrogant assumption, because you're assuming that you are smarter than thousands of people out there, which normally is not the case. I'm sorry to say that, but this is what normally happens. It happens for you, it happens for me, it happens for the world. Right? So the answer to question number 5 is, to go back to the case, is, what is it? Is the probability of conversion high or low? The answer should be, provided that the assumptions given in the exercise are reasonable, the probability should be rather low. Okay? And as all right. Ci vediamo domani. Ok. Nick, tu non hai appuntamenti? Peccato. Anche io ho un appuntamento. Col treno. Un po' più triste.
Che paghiamo.
Che
paghiamo.
E l'altra domanda che è a monte di questa, compute the minimum growth rate of Promodesk share price 9,2%. 9,2%. Ok? Questo, sorry, why am I speaking Italian? I'm sorry. This is the heart of the analysis, because this has a lot of consequences. If you believe that these assumptions are correct, you shouldn't subscribe the convertible bonds. And this is the kind of convenience analysis that all convertible bond investors, starting from the hedge fund investors, they do internally in order to observe these two differences and what they expect these two differences could be. Okay? Question number 6. So when you was there somebody that was able to solve? It's a 1 minute or 2 days answer. Now you know what. Either you know it or you don't. In other words, you have this intuition or not. Okay, let's go ahead. Question number 6. What is the accounting cost of a convertible bond? The accountants are blind. I am an accountant, so I am blind. The accounting cost of a convertible bond is given by the coupon. The accountant will say, what is the cost of this bond? It's the coupon. Nothing else? No. Are you sure? Yes. Okay, wrong. Wrong. I mean, from an accounting standpoint, it's perfect. But who cares? From the financial cost is what really matters. The financial cost is that accounting cost. The coupon is only one part of the overall cost of the convertible bond for the firm. The second, and in a lot of cases much bigger part, is the capital gain that you, dear bean counter, are ignoring. Capito? Nick, you're sleeping?
No.
Am I so boring? No. Okay. Question number 7. Shall we examine it or not? Oh, let's do it. What are the conditions that should be satisfied for reducing the cost of capital in convertible bonds? This is actually, I was wondering if it was worth doing it or not, but it goes back to the exercise of the cost of capital with convertible bonds. The weighted average cost of capital, 3 things, where we observe a decrease of the cost of capital. With that, according to some observers, is only fictitious, because actually you're ignoring the fact that by introducing some convertible bonds in your company, you are also increasing the riskiness of the firm, and thus the expected return by shareholders should increase as well. Question number 8. Why Promodes decided to issue convertible bonds in 1999? What are the advantages of issuing convertible bonds rather than other financing instruments? Convertible bonds in 1999 were useful because, let me go back for 1 second to the graph we were examining before. Voilà. Take a look at the growth rate of Promodes. Scusa. Inquiet. Okay. I don't know, but at home, do they see it? No, not necessarily. No, let's look over here. Okay. 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 Okay.
Schermata просто.
Schermata, bravo, sì. Sì, non mi trattare come un minus Hamlet, no? Sì, schermata proprio. Okay, this is the schermata, my friends. Okay. As you can see, take a look at what's reported here. Promodes has had a terrific performance. Probably, now I got used to the fact that nothing impresses you. But starting from 200 and reaching 700, it means tripling, more than tripling, the share price in 4 years, 5 years. It's a wow. It's a wow. But this wow, that is the picture of the situation, now you are here, you are at the peak, and you're considering issue. You need to raise capital, right? Here, you are here, on the top of the hill, and you want to increase the capital. You need to raise money. What happens if you decide not to use the convertible bonds because you would prefer going directly with a capital increase?
Diluted shares.
What's the action? She said before. I forgot the name. What happens? Right? Because, oh my God, if they increase the capital now, and this is the price at which they're going to sell the shares, and I'm going to subscribe the shares at this price, I'm afraid that tomorrow morning there could be a turning point. I've subscribed the shares at the highest price. Probably there is bad news behind the corner. It's better to stay away. Understand what I mean? Because growth does not continue infinitely. Okay? And this one has increased a lot. So in these circumstances, a good alternative could be, as we have seen repeatedly, a convertible bond. Because the convertible bond says, by subscribing these bonds, you're still betting on a further increase of the price. Okay, and that's a bet. But even if the stock price goes down, it's okay for you. You don't get the capital gain, but you get the money back and you get the interest rate. So you have a safety net when you subscribe a convertible bond. And in fact, convertible bonds are frequently issued when the stock market has reached a very high level and you as an investor have to suspect that bad news could be around the corner. Okay? Question number. I don't know, what are the advantages of issuing convertible bonds rather than financing instruments? We have already experienced that, we've already seen them extensively. We have, some of them are the fact that the convertible bond has a lower coupon, and this in many circumstances could be definitely a plus for the company, especially if you need to have a lot of money internally that needs to be reinvested for financing the growth. Second, you have a lower dilution of shares because you need to issue a lower number of shares compared to a traditional capital increase. Why? Because you're selling the shares at a premium. at a higher price than the current stock market price, and that implies that you will issue a lower number of shares. And thirdly, there is the possibility somehow of matching the cash inflows and the cash outflows of the firm. Question number 9. That's a rather interesting one, but we have already de facto examined it. Are convertible bonds part of equity or debt? Okay. Well, actually, in this case, let's put it in general and then apply it to Promodes. In general, we have already examined this one. Okay, I told you that most observers, according to the probability of conversion, they will treat these bonds consistently. If the probability of conversion is very high, it means that there is a very high probability that you will become a shareholder. So, de facto, let's consider you as a shareholder. If conversely the probability of conversion is rather low, you don't treat the convertible bondholder as a potential shareholder, you treat him or her as a bondholder. And thus you put it in the amount, the value of debt, the value of the convertible bond in the bucket of debt. Concerning Promodes, and that's the end of the analysis of this case, we have seen now the calculation we have made before. We have seen that the way it is structured, the contract seems to be not that attractive for convertible bondholders because the probability of conversion is rather low. So I don't know what your opinion is, but personally, in this case, I would consider the convertible bond as a bond rather than equity, since we have seen with the calculation that the probability of conversion, given the numbers provided in the exercise, is rather low. Questions? Actually, we had in our mind to leave the room by 5:15. Remember this one? It's even better than that. A couple of additional things. So we have a couple of minutes. Not referring to the presentation. The presentation is, of the case, as I told you, is shorter than the Agile case. But the key point was the question number 5, because everything surrounds question number 5. Now you understand it. What I want to tell you is, first of all, let me remind you that we have, tomorrow we're going to start at 9:15. Please be here on time. The second thing is that we have, the second thing I want to tell you is that we have the exam, because I have received an email from somebody, I don't know, from this classroom or virtual, saying, is it confirmed? That's no. Yes, it is confirmed. We have the exam. Your creativity is amazing. Dear Professor, I've seen on the Excel that the exam is planned for the 29th. Is it confirmed? Sì. No, because I need to ask for the work permit. Sì, ovvio. Che domanda è? And is it gonna last 1 hour? Sì. Non capisco. This lack of trust to work. Actually, lack of trust should be the other way around. But I don't have it.